Hello, everybody. Thank you for joining us today. We have had such great interest in today's event, and we're glad you're here. I'm Yannicka Radcliffe, Vice President of Urban Institute's Housing Finance Policy Center, and I'm here to kick us off. So often, I think we look at manufactured housing, rent-to-own, shared equity, land contracts, small dollar loans, and so on as separate niches, special tools for special circumstances. Pew's recent research highlights what unifies them is first, a strong desire on the part of people to be homeowners, whatever it takes. And second, a lack of traditional and mainstream pathways for them to get there, especially for households of color and those with lower incomes and lower wealth. So while today's event promises push and pull, I'm also reminded of the expression, where there's a will, there's a way. And I really want to thank the expert speakers today to help illuminate that way. And explore what the mainstream can do better, as well as whether these alternatives can be safe and constructive pathways. But first, a little housekeeping before we dive in. Just a reminder that the event is being recorded and will be available for viewing online afterwards. You can hide the captions and adjust your settings with the live transcript button. Also, all speaker biography and slides will be available or are available online at urban.org. Throughout the presentation, all participants will be muted, but we encourage you to type your questions and comments in the Q&A box at any time. And find a request to complete the survey at the end of the event. We would really appreciate your feedback, and we'd also appreciate your tweeting using #live@urban. And now it is my privilege to introduce Tara Roche, who is Manager of Consumer and Home Financing at the Pew Charitable Trusts. Thank you so much for your terrific work and setting the stage for today's conversation.
Great. Thank you, Yannicka, for that introduction, and to Urban for hosting this webinar today and having me participate. Very excited to talk about this with all of you. So as Yannicka mentioned, I'm Tara Roche, and I manage Pew's Home Financing Project, which studies the alternative financing arrangements that people use to buy low-cost site-built and manufactured homes and the lack of small mortgages in the country. For today's webinar, I'll mostly be talking about our alternative financing work. Yeah. But first, I want to set the stage and talk through some main takeaways to contextualize our work. First, there are not enough small mortgages, despite low-cost homes available across the US and qualified buyers to purchase them. Millions have used alternative financing at some point to pursue their homeownership goals. These arrangements are often riskier and costlier than mortgages, and protections vary widely. And policies often overlook people who use alternative financing, though some recent initiatives have explicitly included these homeowners. We define alternative home financing as arrangements that are not typically subject to traditional mortgage rules. These include land contracts or contract for deed, lease purchase or rent-to-own arrangements, seller-financed mortgages, and personal property home-only or chattel loans, which are specifically for manufactured homes. Other names for these arrangements exist, but they can usually be classified into one of these categories. Also, each arrangement has different features. One key distinction, though, is when and how the buyer receives legal homeownership. For example, in a land contract, the deed to the home doesn't transfer until final payment is made, typically. In a lease purchase arrangement, there's a clear rental period, followed by an ownership period when the renter exercises that option to purchase. In a seller-financed mortgages, typically the deed to the home is provided upfront, similar to a third-party mortgage arrangement. And personal property, home-only or chattel loans, probably most similar to mortgages, but they still cost more and carry fewer protections than mortgages. So now that we've established what alternative financing is, I'll step through some findings from Pew's national survey, which found that 36 million Americans have used alternative financing to purchase a home. Focusing on home borrowers specifically, that is people who have ever borrowed to purchase a home, whether they've used a mortgage or an alternative of some kind, our survey found that approximately 1 in 5 home borrowers have used alternative financing at least once. And roughly 1 in 15 current home borrowers are in alternative financing today. This has been a major knowledge gap in the research to date, and frankly, the size of this market surprised us. While 21% of home borrowers overall have used any type of alternative financing arrangement, our survey found that 11% of home borrowers have used a personal property loan to finance a manufactured home, the most common type of alternative financing. 6% have used lease purchase, 6% seller financed mortgage, and 5% a land contract. One thing to keep in mind is that names or titles for these arrangements are sometimes interchangeable. What is one person's land contract might be another's rent-to-own agreement. These vary across and within states as well. But it's very clear that personal property loans are the most common arrangement and distinct from these other arrangements. Our survey also allowed us to determine repeated usage. 22% of alternative financing borrowers said they have used more than one type of arrangement at some point. And while these arrangements are often pitched as alternative pathways to homeownership and might work for some borrowers, the repeat usage suggests that some do face repeated barriers to safe, affordable mortgage financing, making their pathways to homeownership more complicated and uncertain. The survey also found disparities in alternative financing across race and ethnicity. In particular, 34% of Hispanic home borrowers and 23% of Black home borrowers have used alternative financing, compared with 19% of white home borrowers and 14% of other, which is those who identify as two or more races or another race. These disparities reflect broader inequities in the housing market and raise concerns about the pathways to homeownership for Hispanic and Black families in particular, as they are often historically underserved in mortgage and housing. The survey also found that 23% of home borrowers earning under $50,000 annually were in alternative financing arrangements, compared with 3% of borrowers earning more than $50,000. Now, it's easy to look at the chart and simply think that low to moderate income families just can't qualify for mortgages. But this isn't just a story about income. Lenders have long had difficulties issuing small mortgages because of, in part, high fixed origination costs. Instead, this highlights how difficult it is to get a small mortgage for low-cost homes, because low to moderate income home buyers are the most likely group to seek homes in this price range. With this in mind, our findings broadly suggest that a lack of small mortgage access and very high manufactured home loan denial rates play an important part in alternative financing usage. We've also completed a follow-up survey to better understand experiences and outcomes, and we'll be out with those findings in the coming months. But at a high level, it confirms some of our early hypotheses, and that in fact, many alternative financing home borrowers may very well be able to take on mortgage payments. And in some areas of the country, these might be less expensive than current market rental rates. But the mortgage market is failing to meet their needs, and experiences vary widely. I want to briefly highlight existing protections in alternative financing. In short, it's a complicated patchwork of federal and state laws and case law that govern these arrangements. We have some listed here for reference, but in short, regulations and protections vary widely, not just by jurisdiction, but by institution or program. And this ambiguity can make it difficult for some alternative financing borrowers to budget or compare options, leaving them in financially precarious situations or unable to build equity or obtain financial assistance when needed. This map shows existing laws for land contract, lease purchase, and seller financed mortgages. You can see the majority of states don't have statutes governing these arrangements. When states do have statutes, often they only cover some aspects of land contract arrangements, which are shown here in blue. And one thing to note for lease purchase and rent to own is even though few states have specific lease purchase laws, the rental part of that arrangement should typically fall under landlord-tenant law, but the option contract usually does not. And our research shows that in practice, some landlords or sellers do not abide by the existing rental protections. Even in states with laws, the reality is sometimes borrowers are treated as tenants and sometimes as homeowners, and this makes their rights and responsibilities confusing. We recently published a literature review that examines the research to date on alternative financing, so I'll summarize this briefly here. So I talked about some of the risks a bit earlier: lack of equity, unable to borrow against the home, unclear ownership, eviction or foreclosure risk, habitability issues, and so on. There are some risks to sellers, but less so than borrowers. For example, borrower non-payment, possible home value decline if the home goes under judicial sale, or unable to sell the property if a buyer exits the transaction early. There are also risks to state and local government. For example, unclear tax and maintenance responsibilities, again, if that home ownership is unclear, possible home value decline, and also a lack of records for these arrangements is a barrier to resource distribution during disasters such as the pandemic. We've also done a lot of qualitative work to begin digging into experiences from homeowners themselves, legal aid experts, and lenders. And a main theme throughout our work is that, of course, people are excited to get into homeownership and are glad that they have an option to finance their purchase with. But often the responsibilities of homeownership are given to alternative financing home borrowers without all of the same rights and protections as mortgage borrowers. I mentioned at the top that there are some federal policy opportunities. Here are two recent ones, for example. The equity plans from the administration that were introduced over the past several months provide a place to encourage policymakers and regulators to study alternative financing borrowers, particularly as they're assessing housing and mortgage needs in communities around the country. And also Treasury's Homeowner Assistance Fund guidance provided a very broad definition of homeownership, including land contract owners and those who have a loan on their manufactured home. We've also been tracking manufactured housing and alternative financing legislation and see some uptick in activity, especially around manufactured housing. Since January 2021, we found 70 manufactured housing bills introduced and 13 passed, and 12 alternative financing bills and 1 passed. So we've covered a lot of ground today. I want to take a moment and reflect on our key takeaways again. So again, there are not enough small mortgages, despite the low-cost site-built and manufactured homes available across the country and qualified buyers to purchase them, in part because lenders have difficulty issuing these loans profitably. 36 million Americans have used alternative financing at some point to pursue their homeownership goals, but some are more likely to do so than others, for example, Hispanic home buyers. These arrangements are often riskier and costlier than mortgages and have a relatively weak patchwork of federal and state laws that vary widely. And lastly, policies often overlook people who use alternative financing, but some recent initiatives have explicitly included these homeowners and offer opportunities to further understand challenges and areas for improvement. To the last point, I'll also add that the next phase of our work will be focusing on when these arrangements do work and why, how we elevate those good practices, root out harmful practices, and encourage lawmakers and regulators at all levels to consider policies that support the many ways people pay for their dwellings, not just with rents and mortgages. So thank you again for having me today, and I will turn it over to Karan from Urban.
Thank you, Tara. Hi, good afternoon, everyone. My name is Karan Kaul. I'm a Principal Research Associate here at the Urban Institute. And I'm going to take the next 10 minutes or so to talk about the role manufactured housing can play in easing the affordable supply crisis. And these remarks are actually based on a recent paper that I co-authored with my colleague here at Urban, Daniel Bang, and also in part based on a blog we're going to come out with very, very shortly. So with that, let's get started. So we all know that the housing market faces a big shortage of homes that is estimated to be somewhere between 4 to 6 million units. And that can largely be attributed to underbuilding of homes during the last 10 years or so. But when you look at the manufactured housing space specifically, you find that we've also been underproducing manufactured homes over this period by a huge margin. That is, in the 20-year period from the mid-70s to the mid-90s, we produced an average of 240,000 manufactured home units per year before the market began overheating in the mid-90s, and that was followed by a crash, and then obviously by the Great Recession. The annual production of manufactured homes bottomed out at around 50,000 units a year in 2010 and 2011, and then since then, production has gone up. It's actually doubled from 50,000 in 2010 11 to about 100,000 units shipped last year. But you can see very, very clearly the extent to which we're simply not producing enough manufactured homes, and especially problematic considering the fact that our population today is much larger than it was 3 or 4 decades ago. Another reason, why that decline in manufactured home shipments is concerning is that manufactured homes actually are, much more affordable than site-built homes. The table here on the left shows key characteristics of newly shipped manufactured homes last year and compares them to the characteristics of newly built site-built homes again last year. And you can see in the very first row, the average price of a manufactured home, excluding the price of land, was $108,000 last year. A newly built site-built home, again, excluding the price of the land, was about $366,000. So the manufactured home actually costs less than a third of what it costs to buy a site-built home, excluding the price of land. When you look at it on a per square foot basis, manufactured homes cost about half as much as site-built homes, $72 per square foot compared to $144 per square foot for a site-built home. Manufactured homes are also purchased by borrowers with much lower incomes than borrowers who purchase new site-built homes, $57,000 per year annual income compared to $93,000. And finally, the last row, which again shows the degree to which we are underproducing. Despite these affordability advantages, we shipped about 106,000 units of manufactured homes last year compared to almost 1 million units of site-built homes produced. So roughly, we shipped just 1 unit of manufactured homes for every 10 units of site-built homes that we produced last year. The table on the right again shows the affordability advantage of manufactured homes, just in a very different manner, and basically by price bucket. So if you look at the distribution of manufactured homes by price bucket, again, this is excluding land and 2021 built homes, about 2/3, 67.3% of manufactured homes shipped last year were priced below $125,000. And 1/3 were priced between $125,000 and $250,000, with almost nothing priced over $250,000. When you look at the site-built housing market, it was an exact opposite of that. That is, about 75% of new site-built homes last year were priced about $250,000, and about a quarter were priced between $125,000 and $250,000, with absolutely no production of site-built housing that was priced below $125,000. Again, these numbers are excluding land price to enable an apples-to-apples comparison. But you can see clearly the affordability advantage, the immense affordability advantage that manufactured housing has over site-built homes. There's also a lot of discussion about the quality of manufactured homes that just never goes away. And so we decided to pull some numbers to dispel that myth. And what you see here is actually results from the American Housing Survey. We looked at 4 survey years, 1989, 1999, 2009, and 2013. And if what it shows is the share of homes, both manufactured homes and site-built homes, that were deemed inadequate in each of these survey years. That means these homes had developed some problems, roofing problems, structural problems, pest infestations, plumbing issues, and so on and so forth. And so if you look at the first row, we cover the period, homes that were built in the 1970 to 1979 period and were surveyed by American Housing Survey a decade later in 1989. In that survey, they found about 9.3% of those manufactured homes were found inadequate. The share of inadequate homes for site-built homes in that survey was 6.6%. So clearly manufactured homes, the quality of manufactured homes was certainly not on par with the quality of site-built homes. Fast forward to homes that were built in the year from 2000 to 2004 and were surveyed about 10 years later in 2013, the share of inadequate homes for both manufactured homes and site-built homes had declined a lot, but the decline was much more precipitous for manufactured homes, where only 2.2% of those homes were found to be inadequate compared to 1.5% of site-built homes. So again, you can see how much the quality of MH has improved relative to site-built homes, and the two numbers are basically highly comparable right now. This slide looks at the most recent HMDA data that was released, sort of looking at how the demographics of those who buy manufactured homes relative to site-built homes has evolved over the last 4 years. And what we show here is the share of home buyers under age 45 for manufactured homes and for site-built homes. You can see back in 2018, about 52% of manufactured homes, according to HMDA data, were purchased by home buyers under the age of 45. In the site-built space, that share was about 63%. So there was a 10.3 percentage point gap between the two. Fast forward to 2021, that gap had shrunk to only 8 percentage points. Why? Well, we had an increase in share of younger home buyers for both site-built and for manufactured homes. But for manufactured homes, especially, the increase was much bigger. That is, the share went from 52% to 56%. For site-built, we just went from 62 to about 63, 64%. So again, that shows some early signs that younger homeowners who historically were not, historically, as we know, manufactured homes were more skewed towards older home buyers. That trend may be starting to change as younger households and first-time home buyers are increasingly priced out of the site-built market. Let me now switch gears and talk about financing and financing hurdles for manufactured homes. As we all know, manufactured homes can be financed in a couple of ways. One, you can either get a manufactured home mortgage, which is very much like a traditional mortgage, which is secured by both the home and the land, or one could get a personal property loan, also known as a chattel loan, which is only secured by the structure. And in this table, I think it's instructive to look at how different the two markets are. That is, just in terms of total dollar volume of purchase originations, we can see that manufactured home mortgages are much more prevalent than chattel loans. You had about 5 billion in purchase chattel originations last year compared to over 15 billion in manufactured home mortgages that were originated. And this is despite the fact that chattel loans both have much higher rates than manufactured home mortgages, 7.8% on average last year compared to 3.5% for mortgages, and a shorter repayment term of 20 years for chattel compared to 30 years repayment term for manufactured home mortgages. And finally, the loan amount, the average median loan amount for chattel loans last year was only $75,000, half of the median loan amount for a manufactured home mortgage. Again, showing the extent to which chattel loans are used to purchase lower priced homes, even though the financing is expensive and the repayment term is much smaller. So that begs the obvious question, why is chattel financing so expensive? Well, one big reason is that the chattel lending market is largely a non-federally backed product. The GSEs, Fannie and Freddie, don't currently finance chattel, although that's something they're going to look at. And FHA's chattel volumes are also small, and they've indicated that they are also going to look at things they could do to address that. What you see here in these two pictures on the left-hand side, the distribution of chattel purchase lending last year, you can see pretty much all lending was done by private institutions and not backed by the federal government. This is mostly chattel loans that are made by a lender, and they then keep the loan on their books for the most part, and then a small amount of those loans get securitized to the PLS market. But again, most chattel financing is not backed by the federal government. On the right, see the same distribution for manufactured home mortgages, which are backed by the federal government. And clearly the federal government plays an outsized role in that market. About 70% of manufactured home mortgages over the years are originated through either Fannie, Freddie, FHA, or VA, and only about 30% or so is non-agency. The share is actually very, very consistent with what we see in the site-built market, where the government share, depending on the year, could be anywhere from 60 to 70%. And then there are a few other reasons why chattel financing is expensive. I think another reason is that the industry is highly concentrated. That is, as the table shows, that share of top 10 lenders based on 2021 volume for chattel, manufactured home mortgage, and site-built and mortgages on site-built homes. About 85% of chattel originations last year were made by just the top 10 lenders. When you look at the other two markets, the number was about 30%. So clearly, much higher lender concentration, which translates into less competition, and so obviously less of an incentive to offer better lending terms. Chattel loans, as I showed a few slides ago, the average loan size is much smaller compared to a manufactured home or even a site-built home. And so that means the lender has to charge a higher rate to compensate for the costs of making that loan, and earning a profit. And then finally, the chattel loans, because they're not backed by the land, it's just a structure which is depreciating. The lender has to price for that depreciation as well, especially given the fact that there is no federal government involved. The risks are simply higher, and they have to price for that too. So several reasons why chattel finance is expensive. At the same time, and despite these challenges, chattel loans actually enable more minority homeownership compared to manufactured home mortgages. The picture on the left shows the distribution of purchase lending in 2021 by race for manufactured home mortgages and for chattel. And you can see in the manufactured home mortgage space, about 19% of those mortgages were originated to either Black, Hispanic, or Asian borrowers, whereas in the chattel space, about a third of all those chattel loans were originated to Black, Hispanic, or Asian borrowers, with Hispanic borrowers actually comprising most of that market. When you look at the same numbers in absolute terms, which is the table on the right, that shows the number of purchase loans originated, and this is actually cumulative from over a 4-year period from 2018 to 2021, because I wanted to show the aggregate impact. You can see that when you look at white borrowers, about a total of 311,000 manufactured home loans were originated to white borrowers. About 200,000 of those were mortgages, 115,000 were chattel. The share of chattel was 37,000. And you look at the same data for Black, Hispanic, and Asian borrowers, you can see that chattel loans were much more important than manufactured home mortgages. That is, about 64% of all purchase lending to Black borrowers during this 4-year period was chattel. And for Hispanics, it was 56%, and for Asians, the chattel share was 53%. So clearly, chattel lending, in spite of being expensive, in spite of having a shorter term, plays a much bigger role in enabling homeownership for Black, Hispanic, and Asian borrowers compared to manufactured home mortgages. I also wanted to point out chattel loans, chattel loans have extremely high denial rates for all racial groups, but especially for minorities. These are denial rates for chattel purchase loans in 2021, and the 3 bars on the very right show the total denial rate for all racial groups. You can see for chattel, the denial rates were highest at close to 64%, followed by manufactured home mortgages, for which the denial rate was 44%, and for site-built homes, which had a denial rate of just 9%. And then when you look at the denial rate by race, you can see pretty much a consistent pattern where chattel loans have high denial rates, but Black applicants have had the highest denial rates at 76%, followed by Hispanics at 69%. And then manufactured home mortgages, where the denial rates were lower than chattel. But what is striking here is if you just focus on denial rates for chattel and manufactured home mortgages for Black applicants, you can see there's almost no difference. Black applicants were equally likely to have their chattel loans denied as their likelihood of getting denied for a manufactured home mortgage. Whereas for whites, Hispanics, and Asian borrowers, they actually had a much lower denial rate for manufactured home mortgages compared to chattel. And that's just something very striking to note. Chattel loans are also refinanced very, very rarely. And this slide shows the refinance share of all originations in 2021 by race and construction method. So you have the site build mortgages where you can see the refinance share was very consistent across all racial groups, ranging from about 53% to 61% in a very tight band. The refinance share for manufactured home mortgages was lower, but still, there was some variation between whites and minorities. And then when you look at the chattel market, where the refinance rates for all racial groups were just very, very low, on an average of about 10%. That is, only 1 out of 10 chattel loans were refinanced last year, despite generationally lower interest rates. And so, especially for Black borrowers with chattel loans, the refinance rate was just an absolutely dismal number at 1.7%, and that's just something that needs to get fixed. So again, what that means in the longer run is that if these borrowers are not able to refinance these loans that carry very high interest rates, they are going to be paying more for these loans over their lifetime, and that means less opportunity to build wealth and save money. So final thoughts, as we all know, hopefully I have quantified that manufactured housing is one of the most affordable types of housing out there, costing about a third as much as site-built housing. But we still see that the production of manufactured homes remains very, very low. And that's largely attributable to zoning issues, as well as financing barriers, especially for personal property loans. Compared to manufactured home mortgages, chattel loans are very expensive. They have extremely high denial rates and are rarely refinanced. And because of the outsized role chattel plays in enabling homeownership of manufactured homes for Blacks and Hispanic borrowers, it also means that these costs and burdens do end up falling disproportionately on those populations. And so with that in mind, policymakers actually have begun to recognize this problem. And some of the recent actions that have been taken is that FHFA's finalized duty serve rule actually has built-in support for manufactured housing. The administration has released their action plan on supply, and manufactured housing is a huge part of that, both production as well as financing improvements. And then finally, the FHA and Ginnie Mae recently released a joint request for information on Title I lending with the goal of improving their chattel financing program. So as in the months ahead, we continue to work on resolving these issues. I think it's important to remember that, like with the rest of the housing market, there are inequities built into the chattel financing market, and it's important to actually address these inequities if we want to really narrow the racial homeownership gap that's been around for all these decades. Thank you. And with that, I will transition it over to Mike Stegman to talk about lease purchase.
Thanks very much, Karan. My presentation is based on a Moody's Analytics paper on lease-to-purchase, co-authored with Jeb Mason and Mark Zandi. And with that, we will so the proposition that we lay out in the paper is that homeownership is no higher today than it was 2 generations ago, and the prospects for increasing homeownership are daunting, given higher mortgage rates, declining housing affordability, and broader demographic trends in which new household formation is likely to increasingly come from households with less generational wealth. We think that policymakers would benefit from some new approaches to expanding homeownership, in addition to those focused on expanding the credit box. And with appropriate guardrails and prudent government financing support, we argue that the nascent privately capitalized lease-to-purchase industry may be poised to offer one such approach. Lease-to-purchase arrangements give households the ability to choose a home to rent until they're financially prepared to purchase it. And unlike previous generations of lease-to-purchase arrangements, the new business models offer participating households the right, but not the obligation, to purchase the home at a predetermined price when they're ready. In single-family housing markets fueled by investor-based cash purchases, we think that lease-to-purchase companies can help level the playing field for aspiring homeowners by negotiating cash offers on homes selected by those participating households. And they're a way for households to use their rental tenure to improve their credit scores by making regular rent payments, build a credit history, and save for a down payment. We believe that the lease-to-purchase industry has the potential to materially increase homeownership in underserved communities, including the 2 million Black Americans and 3.5 million Hispanic Americans that Freddie Mac estimates are in their home buying prime and near mortgage ready. The last decade has seen the emergence of a number of private companies focused on lease-to-purchase. The most mature of these are Trio, established in 2001, and Home Partners of America, founded in 2012. Other notable firms in the industry that have recently been established include Divvy, Halo, and Verb House in 2017, Dream America and Zero Down in 2018, and this year, Pathway Homes. All lease-purchase companies set their own so-called buy boxes, which provide lower and upper bound price limits on the homes they're willing to buy on a household's behalf. And you can see there how some of the companies define their buy boxes. The minimum income requirements generally for lease purchase companies range between $30,000 and $48,000 a year and require minimum credit scores that range between a low of 480, and 620. Because single-family homes listed for sale have asking prices, but not asking rents, using proprietary algorithms the lease-to-purchase companies estimate live rents for the single-family homes listed in MLSs in their active markets. And based upon the company's underwriting requirements, approved applicants receive a rent budget that enables them to shop for a home that they can afford to rent and ultimately purchase. There are four major elements or components of lease-to-purchase arrangements or contracts. The first is the term, which is the maximum number of months the contract is in force, and it's a series of one-year lease periods with renewals, or they can be for a fixed amount of time. It depends on the individual company. The second element of the arrangement is a purchase price, the price the household pays for the home when it closes at some future date. And then this would include periodic price escalators, all of which should be specified in the contract itself. And then there's the option fee, an upfront payment that becomes part of the household's down payment if the option to purchase is exercised. And option fees can range from zero, no cost to exercising the option, to 5% of the home price itself. So the option fee is a huge element of lease-to-purchase contracts. And then on top of that, there are what might be called rent credits. That is, any additional above market rent paid by the household to the company, which becomes part of the household's down payment when the option is exercised. So if we begin to think about a policy framework for lease-to-purchase arrangements, certainly the first element would be about transparency and disclosure. And so if you think about that right to purchase option, we think that as a condition for consideration for federal financing, policy makers should require appropriate disclosures that apply to the purchase option, including the option cost, annual rent and house price escalators, and the financial consequences of not exercising the purchase option. And that final part is really important. What happens if the purchase option is not exercised? And then because of that rent credit element that we talked about, the transparency and disclosures need to account for the disposition of those forced savings, those payments above and beyond the actual rent that is paid, the contract rent that is paid. In addition to that market-based rent, as I said, some companies require households to make those additional payments, and they're intended to help grow the down payment that is available when they exercise the right to purchase. And while those funds would be routinely accounted for in the event of a successful household purchase, their disposition and refundability needs to be made clear for households who do not exercise their option. And certainly about transparency and disclosure, since lease-to-purchase arrangements are intended as an alternative pathway to homeownership, companies need to disclose their homeownership success rates. So we say companies accessing federal financing should periodically be required to report the number and rate at which their households successfully transition to homeownership by buying the homes they initially occupied as renters. Very few companies publicly report their homeownership creation rates in their online marketing materials or FAQs or other documents online. And for our paper, our Moody's Analytics paper, in an effort to advance the lease-to-purchase policy discussion, Home Partners was one of two featured companies that disclosed their homeownership success rates. And that's what you see in the chart. From its inception in 2012 through May 2022, Home Partners of America has helped approximately 30,000 households in 33 states, including more than 4,300 who bought the home they initially moved into as a renter. And the homeownership creation rate has risen to 43% in 2022 for all households, independent of when they moved in and signed their initial lease. So we have also policy recommendations for conditions for government-backed financing. Instead of limiting federal government support for lease-to-purchase to nonprofit or governmental sponsors, we think that policymakers should consider prudently expanding support to those private for-profit lease-to-purchase companies that show the greatest promise for increasing homeownership for households that are close but not yet able to qualify for a traditional mortgage, and for narrowing wealth gaps. Government-backed financing should be available only to lease-to-purchase companies whose products are structured in a manner consistent with the prudential, affordable housing, and equitable finance policies of FHA and the GSEs. We believe that companies that receive federal financing should offer products that leave households not materially worse off than similar renters in the market, should those renters choose not to exercise their right to purchase. This gets to the refundability nature of that option fee and related costs associated with not exercising the right to purchase. Regulators should permit any paper equity generated from house price gains during the household's lease period, determined by an appraisal that exceeds the option sales price, to allow that equity to accrue to the household to cover all or some portion of the required down payment at loan closing. And finally, if we look at FHA and GSE financing recommendations, we believe that FHA's single-family purchase mortgage that already has an assumable feature should be streamlined and broadened to make it more widely available and effective in supporting increased homeownership through lease to purchase. Carol Galante, former FHA commissioner, has written a paper on creating an FHA lease to purchase product that we describe and discuss in the paper and recommend for policymakers' consideration. And then with regard to FHFA, they should set the terms for and encourage Fannie and Freddie to pilot lease to purchase mortgage products as part of their affordable housing and equitable housing finance missions via the provision of term financing and the addition of an assumable feature to their affordable low down payment mortgage products, and incorporate rent seasoning into both their underwriting and pricing. And these recommendations are fully discussed in our paper. And with that, I will conclude and turn the platform over to Lori Goodman, who is Institute Fellow and founder of the Housing Finance Policy Center. Lori?
Thank you very much, Mike, and I want to thank all three panelists for doing a fabulous job. With that, I would like to introduce my distinguished panel. We have Stacy Epperson, the founder, president, and chief executive officer of Next Step Network. Akila Watkins, president and chief executive officer for the Center for Community Progress, and Bill Young, co-founder and chief executive officer of Home Partners of America. A few quick reminders: the speaker bios are the links to the speaker bios are in the chat. And if you have any questions, we'll try to leave a few minutes at the end for questions and answers. Put them in the Q&A box. What I'd like to do is, for each of you, can you spend 2 minutes apiece introducing your organization or business? And let me start with Stacy.
Thank you, Lori. So good afternoon, everyone. And I work for Next Step Network. We're a national nonprofit housing organization, and we promote the expanded use of factory-built housing as a viable solution to address housing affordability. Our mission is putting sustainable homeownership within reach of everyone while transforming the manufactured housing industry. We'd like to see it work better for consumers through consumer education, affordability, and energy efficiency. We mobilize a network of mission-driven developers, housing counselors, lenders, and leaders in the manufactured housing industry to serve homebuyers in their communities. And we run on a system called Manufactured Housing Done Right, where we connect responsible financing, homebuyer education, and delivery of high-quality Energy Star manufactured homes. Thank you.
Great. Akila?
Hi, hello everyone. I'm President and CEO at the Center for Community Progress. We are a national organization that works primarily with municipal governments on helping to convert and transform vacant and abandoned property into community assets, affordable housing being one of those. We are the only national organization that does this. We have worked in over 300 communities across the country, transforming local, county, and statewide land use legislation to allow more local control of land. And I'm excited to talk about affordable housing alternatives and also to respond to the wonderful panelists we had this afternoon. So thank you.
Thank you very much. Bill?
Thank you for including us, Lori. Our company, Home Partners, was formed in 2012. Our mission is to help provide a new path to home ownership for consumers who are not ready or able to commit and buy a home in today's housing market. Our lease purchase program is built on transparency, choice, flexibility, and control, and we've helped thousands of families buy a home. The way it works is consumers identify a home they love in a good community. We buy the home for them. They sign a 1-year lease. They have the right to extend that lease up to 3 to 5 years, and also the opportunity to buy the home, but no financial penalty if they decide to move on. You know, one of the interesting things we found is we've helped more than 30,000 families. The average income of our consumers is about, our households is about $130,000. It's been very difficult to help serve $50,000 to $60,000 families. And we're excited to really push and help address that challenge through Choice Lease, which is enabled by a commitment from Blackstone for $1 billion to help 80% AMI consumers get access to a good home in a good community. And to be very quick about it, we are providing 10% below market rents. We allow the consumer to control the house up to 5 years. Rent increases are capped at 3.75% a year, and they can buy the house over that 5-year period for 3.5% above our cost and a 3.5% escalation rate each year. So again, we're very excited. We believe it's scalable, and we look forward to talking to the group about that today.
Thank you very much. What I'd like to do is start and ask each of the panelists, what was your reaction to the presentations? And let me start with Akila, and then we're going to go Akila, Bill, and then Stacy. So just hand it off from one to the other.
Great. Wonderful to start. So I was really impressed with the panelists and the information that they shared. And so a couple of things I would like to highlight One is the small mortgage balance program. This is particularly of interest to the Center for Community Progress. We are the national organization that is the #1 technical assistance provider for the country's land banks. And land banks serve as repositories for vacant and abandoned property in many cities and counties across the country. And so one of the challenges that land banks have traditionally had is not being able to move these properties directly to consumers. So land banks have they are quasi-government entities, and why they are is because they are endowed with special powers such that they can clear title and they can actually remove back taxes. And so we would love to be, land banks would love to be able to move these properties that they currently have in their repository directly to consumers as home buying opportunities. The challenge is, and this came through in the presentation, the Pew presentation, is that there isn't a mortgage mechanism to be able to finance these home ownership opportunities, especially in a lot of weak market cities that could really benefit from an increase in home ownership opportunities, especially for African American and Latinx communities and low income home buyers. And so I was particularly excited seeing this conversation come up about small balance loans, because I do believe it's an important strategy in terms of how do we increase the housing supply in this country. And so we know that there's a $4 to $6 million a 4 to 6 million shortage of housing available for this country. And I think that our vacant and abandoned stock is one of the ways that we can shore up this gap. It's not going to shore up all of it, but we do feel like there's a sizable amount, roughly around 8 to 10%, that vacant properties can actually fill. However, though, pointed out by our first panelist, one of the challenges is that there isn't a mortgage mechanism. And so I think I would love to have a broader conversation around what that looks like. And we're looking at even mortgages that are $100,000 and below. And so having a mortgage mechanism for homeowners, low income, working class families that can be able to get this land and get these actual properties, but we have to figure out what the mortgage mechanism is. And then we also can figure out the capital pools needed to be able to do the necessary renovations on these properties. So families don't have to acquire that debt to renovate properties up to code. They can actually get a turnkey. And so this is a wealth building strategy. This is a community revitalization strategy, and it's also an affordable housing strategy. So I'm looking forward to talking more about that. And I'm happy that this topic was brought up today. So thank you.
Laura, do you want me to jump in? I thought the presentations were also very helpful and informative. We agree working families need more affordable home ownership solutions and ways to get into home ownership. It's extremely frustrating to our team that many households, and particularly families making less than $50,000 a year, have to rely on alternative financing products created by companies that don't put customer needs first. And we also agree with the Stegman, Mason, Zandy research that a significant opportunity exists to increase housing options and homeownership in underserved communities through lease-to-purchase programs. And as I mentioned, we're attacking this through our Choice Lease program that is focused on helping families making less than 80% of the area median income. And we also believe that companies like ours that align their interests with the consumers will create better outcomes and hopefully drive sustainable home ownership through lease purchase programs.
So Laurie, I'll jump in. My reaction is that I got a confirmation that manufactured housing has a vital role in solving the affordable housing gap. I believe the researchers focused on the most critical issues, and they mostly got it right. It reflects the reality of what practitioners and what we see on the ground. But there's a couple of areas that I want to highlight. And then I want to talk about maybe an area where we might need a little more research. First, I want to just emphasize the shift in consumer attitudes and demand. We're finding, and the research shows, millennials are more open than previous generations to manufactured housing. We believe some of the reasons are that they're exploring the benefits, the affordability, and really the sustainability in how the homes are built. We partnered with IKEA on a national homebuyer survey, and we got confirmation that this generation is more open to these homes. And I think it has something to do with the HGTV tiny home effect. That we've kind of educated consumers on a smaller footprint living. And I think it's helped negate some of the outdated perceptions about homes being built in factories. And so we do know stereotypes still exist, but we can overcome those with proper education and facts. In fact, let me share a fact because I've seen some of the questions. A manufactured home meets a national HUD building code. It's a performance-based code and it's preemptive to local code. Modular housing, we build that too in factories and it meets state code, okay? And then the last thing I have to say, we haven't built mobile homes since 1976 when the national HUD code went to effect. So that's one fact that I'd like to get out there. The second thing I'd like to talk about is really zoning reform. And if we're going to develop in cities with high rates of substandard housing, we really need to look at outdated information at the local level so jurisdictions can take on this reform to allow manufactured housing. I just want to point out some additional research. Freddie Mac has done a great project identifying the opportunities to expand manufactured housing. And they really looked at what I'd say MH-friendly jurisdictions, and it can be a roadmap for affordable housing developers. The third thing is that I'd like to point out that quality has been improving over time. And I think that Karan did a great job of showing that data to us. And I think we're going to see better data more long-term as we continue to make changes. Now, I don't think there is a silver bullet for increasing the role of manufactured housing into expanding the supply of affordable homes. But to fulfill that promise, it's essential that we get it right. And how do we get it right? Well, for us, we think it's really getting the quality right, the energy efficiency, but also preparing and supporting home buyers. There's too many ill-prepared borrowers who maybe are taking chattel loans, which may not be their best path forward. So they need just some support and education to do that. We know that chattel can be more expensive and it can also have fewer consumer protections. So what concerns me about this call for securitization of chattel is that we just need to make sure we have these consumer protections, that we have homebuyer counseling and education, and I think plain spoken information available at the point of sale for explaining the implications of their loan choice. And if we have securitization for chattel, the GSEs are most likely to cherry pick the best loans, the best credit scores, the lowest risk. There's still other parts of the market that need more research where consumer credit scores may be lower and they may be the most vulnerable. And we want to make sure that they're getting consumer protection too. So at Next Step, we support chattel loans with these guardrails. Thank you. I'll give it back to you, Laura.
Thank you very much. And Stacy, you touched a little bit on my second question. The order here is going to be Bill, then you, then Akila. Are there best practices that you would suggest that would make these products better for the consumer? And again, Bill, Stacy, Akila. Just go one.
Sure. I'll start. So again, as Dr. Stegman pointed out in his presentation, it starts with transparency, making sure the consumer understands clearly what their financial obligation is. If there are any non-refundable fees, excess rent that's not returned to them if they don't buy the house or they don't rent the house for an extended period of time, making it clear, easy to understand what is the obligation the consumer's signing up to. The second is, we believe the consumer should have the right, but not the obligation to purchase the home. And so there shouldn't be any adverse financial consequences if the consumer does not successfully purchase the home. Terms, very important, providing an extended period of time for a family to become rent ready. In our program, it's 5 years, except for in Texas. And again, we limit the financial obligation to the consumer to just 1 year rent with no non-refundable fees or deposits. And then the option fee that Dr. Stegman talked about, requiring somebody to pay something upfront that they forfeit in the event that they don't purchase the home. Because of the historic difficulties with some of the families that we help accessing credit, we think the number should be 0. And there should be no option fee that's lost in the event the consumer doesn't successfully purchase the home. And then finally, we've talked a little bit about rent credit and excess rent. And again, we think that it's very difficult from an affordability perspective for a lot of families to access a home that they can afford in a community where they want to live. And so to add excess rent, even if it is refundable, really reduces the number of homes that the family can access in the event that you're disciplined and you look at the front end and back end ratios that are similar to Fannie, Freddie, and FHA in providing an approval to that customer. So again, I would go back to Stegman's paper and we agree with all of his policy recommendations.
So 2 best practices, I think, for manufactured housing are first, this home buyer education idea that I suggested, and also down payment assistance. First, we know the research tells us that home buyers who complete home buyer education have better outcomes in home ownership. However, the manufactured housing lending ecosystem has mostly been isolated from the affordable home ownership and home buyer education professionals. It's just, we've been in silos. And only in the last few years have we been able to bring some limited programming to the point of entry for home buyers seeking a manufactured home loan. So more needs to be done. But we've had some positive, I think, effects through these programs to make sure families get all the information they need. And what we have found when they have a mortgage, they're in a high quality Energy Star home, that their odds for home buyer success really improve. So I'd suggest more education to get out there for these types of loans. But here's an issue that we're facing. The housing counselors need to be educated, okay? We did a survey and found that 76% of our respondents indicated that they spent 0 to 15 minutes on manufactured housing and home buyer education. And only 38% recommended a manufactured home to a client in the past 2 years. So we know we have a lot of work to do on that. And next step is partnering with policymakers and intermediaries to expand that education and support for our counseling field. The second area I want to touch on is down payment assistance. It can really improve the access to a good loan for a manufactured home buyer. And according to downpaymentresource.com, only about 28.8% of all the down payment assistance programs track or allow purchasing a manufactured home. So we know we have a lot of education and change to make there, and we see this improving, albeit a little bit slowly. But recently, Freddie Mac clarified that borrowers could use a down payment assistance award to award a choice home loan for a manufactured home. So we see that as very positive. And I'll pass it off to Akila.
Great, thank you. So I think there are a couple of things I'd like to mention. One is creating a mortgage product. That is absolutely important. The largest challenge with getting small balance loans is the origination fee that a lot of financial institutions would incur. Unfortunately, it costs probably a little bit more or the same to amortize a 20 or 30 year loan that's $75,000 that it does for a loan that's like $500,000, right? So we have to come up with better business practices or a new mortgage model for us to minimize the origination cost of these loans. or think totally out of the box around sort of what are some innovative mortgage products that we can use for small balance loans. So that is one of the sort of pressing challenges or things that absolutely need to be sort of worked out. Because if not, we'll have a lot of investors be buying a lot of these homes, and that takes away, again, homeownership opportunities from our most vulnerable and working class families. Two is creating capital pools of, with flexible capital that land banks can use to actually renovate these properties. So as land banks get them through the tax foreclosure system and the code enforcement system, or through simple abandonment, they need to be in a position through capital that they can actually work with local developers to be able to renovate these properties. Only that, with that strategy, we want families to be able to get turnkey properties and not have to take out additional debt to renovate properties and bring them up to code. Again, these are strategies that work primarily in weak and moderately priced cities. And I'm more than happy to talk about that in some of our more, smaller and medium-sized cities too. So, being a little bit more sort of nuanced as it relates to strategy. And then I think a third strategy I want to present is the ideal that land banks and community land trusts have been piloting deep partnerships and across the country. And why this is important is that there may be some markets that are really accelerating their home ownership or accelerating their housing prices, right? And so just, really quickly, we don't have sort of one uniform housing market across the United States of America. We have multiple mini markets across the country. And so community land trusts have predominantly been used in some of the more high market and moderately priced cities as a way to preserve long-term permanent affordable housing. And so land banks and community land trusts have been piloting affordable housing strategies across the country over the last 5 years. And so what that does in essence is that we can help working class families be able to acquire properties, again, assuming that mortgage products are created, but then the community land trust can actually hold that property, the land of that property in perpetuity. And what that does is that a family may decide to stay there forever. If they don't, they may decide to sell, get their share of equity, and move on into more conventional housing markets. But what it does is that it helps that property stay permanently affordable for the next family. Because another challenge that we do have is that, a lot of these strategies get implemented, but they're not permanent. And so we lose that sort of long-term permanent investment in affordable housing in a lot of markets. And so I think we need to have not only a short-term point of view, but we also need to think about long-term and permanent affordability across our very diverse housing markets in the country.
Well, thank you very much. And I'm now going to ask each of you an individual question that's sort of tailored to your field of expertise. So Stacy, from the late 1970s, when the HUD code for MH was passed, to the mid 1990s, Quran showed that we were shipping about 240,000 units of MH a year. Last year, the number was just north of 100,000. MH, as we talked about, is the most affordable form of housing. What can we do to increase the supply?
Yeah, well, over the last year, we've had a shortage of factories and labor to meet the demand. I mean, we saw backlogs of orders that stretched out in some markets for a year. It was challenging to get a factory even to take our order, and they had to allocate to their existing retail channel. But today that backlog is beginning to get shorter. I think the market's probably softening a little bit with the increase in interest rates. The industry overall profitability has been solid. We've seen gross profits increase at the retail level. So we're hoping that these profits are going to be reinvested into expansion, right? We need to build more homes, a lot more homes. We need overall growth, but to do that, I think we need federal and state policies, tax incentives, and investment for innovations that increase the productivity of retained skilled workers and to train new workers into this industry. So, it's time for a national framework and strategy to increase these skills and education necessary, I think, for advanced construction. When we're starting to talk about maybe robotics, we need these incentives to recruit new manufacturers and grow and retrofit the existing factories that are really willing to build a home for the future, to push the boundaries of what technology we use today and move toward this advanced manufacturing to increase production. I think we have to streamline the HUD approval processes and give HUD the funding it needs in the manufactured housing program to fully support the manufactured housing program and to grow it. I believe the HUD code needs to be revisited, not incrementally like we do now, but comprehensively, so we can catch up to our international competitors. We build about 10% off-site. Compare that to Japan at 20%, Germany at 23%. China has a goal to get to 30% by 2030. And in Sweden, 45% of all homes are built in a factory. And their technologies have bypassed the US methods. We have a lot to learn from Sweden. I think we need to 2x our efforts, investments, and training under a comprehensive national policy supported to really increase the productivity of these factories to expand them to meet America's affordable housing needs.
Thank you. Bill, in your introductory remarks, you talked about the $1 billion commitment to scale Choice Lease to help serve residents less than 80 AMI. Do you believe Choice Lease can be successfully scaled and help narrow the racial homeownership gap?
Absolutely. In fact, we think we've proved that the Choice Lease model is scalable and can help solve the challenges faced by families making less than 80% of the area median income. And we're very optimistic that Choice Lease will also help close the racial homeownership gap in a responsible and meaningful way. We've created Choice Lease knowing that Black and Latino households are twice as likely to rent and a credit score to purchase a home than white households. And by establishing a consistency in paying rent on a timely basis, as Dr. Stegman pointed out, the GSEs are now, Fannie and Freddie are now including that in the underwriting for borrowers in providing the mortgage credit. So, Choice Lease is, addressing that issue directly. Second, we talked about the affordability challenges. We're providing 10% below market rent to help a family get into a better home in a better community or save at their discretion to prepare to become a homeowner, while still being disciplined about making sure that the front end and the back end ratios map into Fannie, Freddie, and FHA credit criteria. So, we think that Choice Lease allows consumers to access a great home in a good community. A lender can use timely payment of rent to support their credit decision and helping them access a mortgage in the future. And if the home's not right for the consumer, they can just move on and there's no financial penalty. And then furthermore, in today's housing market where house price appreciation is running in double-digit numbers and leasing rates are also increasing at high single-digit or low double-digit numbers in all of the markets where we participate, capping those rent increases also allow the family to control the asset over 5 years and get themselves ready to buy the home in the future while not taking the downside risk if house prices go down. So yes, we're very excited about Choice Lease.
Thank you very much. And Akila, if you were made emperor for a day, what would you do to increase the supply of affordable housing?
That's a great question. So again, I'm going to keep beating my drum. I think that in this country, we have millions of vacant property that have the potential to help quelch the affordable housing gap in this country. It's not going to solve it fully. Again, according to the National Association of Realtors, we're at a 4 to 6 million affordable housing gap in this country. So it's not going to solve it, but it will make a dent in it. I think all of the strategies we talked about today are going to make a dent in it, but we have to try multiple strategies here because multiple markets call for multiple strategies. And so if I was empress for the day, I would absolutely want to move the vacant properties that are currently nuisance properties, bringing down their neighbors' property values, not bringing in any tax revenue for local counties, serving as both health and safety risk for communities, which then in turn drive up municipal cost. I would want to eradicate the vacancy problem across the neighborhoods in this country and move those homes to families that want to deeply invest in space, that want to deeply invest in community. And we can do this. We just need the will, and we have to create the ecosystem needed to be able to do that. And so, that would be my strategy.
Thank you very much. And I'd like to move to audience Q&A reasonably quickly, but since we have a lot of policymakers in the audience, do you have any last thoughts you want to share? We'll go Stacy, Akila, Bill.
Sure. I'm going to speak to HUD just a minute. I think it's time to rethink HUD's role in manufactured housing. Traditionally, HUD's been focused on two things: the FHA Title II loans and the HUD code itself. And it has really this tiny budget for regulatory function, right? And it thinks about it, manufactured housing from through a regulatory lens. I would say, what if HUD shifted its priorities and focused on its role, manufactured housing's role in affordability, energy efficiency, closing the supply gap, and really a more sustainable way to produce affordable housing? I'm encouraged that I'm beginning to see that thinking and those movements and hope they can make a reality. But we can also integrate it into all the programs at HUD, all the innovations, let it work with CDBG, home, promote the technology innovations, fund zoning policy solutions, and have manufactured housing elevated at all the HUD internal programs, resources, and decision-making to value its promise to help close the supply gap. So thank you.
So there are a few policy opportunities. One is the Neighborhood Homes Investment Act. It was in the Build Back Better legislation that didn't move forward in the Senate. However, it will become a standalone bill. We're really excited about this. This will allow for a tax credit for homeowners living in low and moderate income neighborhoods to be able to close the equity gap that hinders so much for low-income homeowners, right? It disincentivizes like deep investment in their home because the equity isn't there, or it doesn't allow developers to build necessary housing in a lot of weak market cities because the equity simply isn't there. So I urge you all to call your local congressperson and tell them to learn more about the Neighborhood Homes Investment Act. This is being endorsed by the White House, and the Center for Community Progress has been one of the organizational architects of this. The second is the National Land Bank Network Act. This is a piece of legislation that was introduced in the 117th Congress. It will be reintroduced in this Congress. It is co-sponsored by Dan Kildee, Congressman Dan Kildee, and Congressman Drew Ferguson. It is gaining a lot of bipartisan support. And right now we're working on the Senate companion piece. This bill will allow land banks to have the flexible income that they need to be able to take on more properties that are nuisance properties across the country. Again, this will increase the opportunity for affordable housing options for our most vulnerable families, but land banks need some help. There are over 250 land banks across this country, and there is not federal dedicated funding for them. So please, again, support the, the National Land Bank Network Act. And so I'm just trying to think, there's so much exciting things coming out of Congress. And the third piece is that while Build Back Better did not move forward, it is important for us to understand that housing is part of America's infrastructure, and we need the deep federal investment of housing. And so it's important for all of us to work with, advocate, amplify the importance of affordable housing and any large infrastructure bill that goes forward in Congress over the next few weeks and months. Thank you.
Great, I'll jump in, Lori. So just a few quick thoughts. I think there are some wonderful opportunities to support the development of programs like Choice Lease without legislation. Today, it's all privately funded. It would be wonderful first to make it very simple and clear to a consumer. If I pay my rent on time for a fixed amount of time, I have a map into a Fannie, Freddie, or FHA loan. Right, and really simplifying that credit access for consumers who successfully prove that they can pay on time, are still employed, and the financial ratios make sense. That would be our first simple ask. The second ask would be, we want to help more people succeed. If we could put a mortgage on the house, ideally lock the interest rate, so the family knows if I successfully pay my rent on time for whatever period the underwriter wants, I know that my payment when I'm ready to buy the house is X. Is very actionable and easy for them to execute. And again, we believe that both FHA and Freddie have tools that would allow this to happen. And then finally, Dr. Stegman talked about term funding. To the extent the GSEs wanted to provide term funding to programs like Choice Lease, what we'd recommend is making sure that all the economic benefit, to the extent there is any, flows through to the benefit of the consumers in the form of a reduced rent. Again, to make sure that we expand affordability and access to homes that the consumers otherwise would not have access to today based on where market rents are. So those are my quick asks.
Fabulous. We have a few, I'd like to thank the speakers, for the panelists, for their remarks. And we have a few questions. I think we only have time for one or two. So let me start with the first question. I'd like to hear generally how the panelists balance the need to provide additional options for home ownership with the importance of promoting residential integration and access to high opportunity communities. Are the types of housing available for alternative financing inconsistent with the kinds of homes in high opportunity communities? Who wants to start there?
I can start real quickly. I don't know, we haven't studied all the alternative forms of financing that Pew mentioned in their paper. But what we do is we provide access to great homes and good communities. So we provide mobility. Again, we underwrite a consumer, we let them pick the house that works best for their family. We'll buy that house for them, lease it to them. And in Choice Lease, it's a 10% rent discount that the consumer pays for up to 5 years while they control that home. So we do think that we're providing mobility and flexibility to the consumers that we serve. But again, I'm not familiar with all the alternative programs that Pew discussed.
Yeah, I think that this is a great question, and one that we need to have a lot more thoughtful and strategic conversations around. So one of the things is that in terms of high opportunity neighborhoods, or making sure that we are building homes where families have an opportunity to access transportation, childcare, jobs, is extremely, extremely important. And so I actually think we as a field, we've done a really good job, and I think we need to continue to do a great, continue the job of working with developers that want to do mixed use projects, affordable housing projects, especially those multifamily projects, that they build these, this housing near or be in conversation with local transportation entities and organizations. We cannot simply build housing that doesn't connect family, because if we do that, we are going to repeat a lot of the challenges of the past. And we do not want to economically and socially segregate families, especially families of color who desperately need to be connected to those good paying jobs. So I think that has to be a larger conversation. This is a panel in and of itself. But I do think, and I appreciate you raising the question, and I think we have to be very deliberate about where we are putting housing and who are we building housing near opportunity centers for.
I mean, I would just echo that. And the only thing I would add is that through the Next Step programs, we put all our homes on an FHA Title II foundation. So what does that mean? That means that the home buyer qualifies for a mortgage because it's a permanent foundation. And so we stay in that mortgage bucket, and the amount of chattel we do is limited to, I would say, where consumer protections are in place. So we partner with resident-owned communities, Rock USA, where there's a collective cooperative owning that property. Homeowners own the land. And so, that's a case where we work and the families would take a chattel loan. Why that FHA Title II foundation, though, is important for mortgages for us, it also creates a system when that home buyer goes to sell that home, that another home buyer can qualify for an FHA loan, right? So in the research, and it was apparent that many chattel manufactured homeowners were not refinancing. And so I took a mental note there, perhaps because they're not sitting on a permanent foundation. Can they go out and get a mortgage at that point? So that's something for us to look at.
Well, thank you very much. We're actually over time. This has been a fabulous conversation. I want to thank the three great panelists and then also the three presenters. Thanks for joining us. I'd like to thank the audience for joining us today. You've been great. And thank you all. Take care. And don't forget to fill out the survey.